Hi, and welcome to this webinar on making informed decisions. My name is Raymond Moses. If you can see me and hear me clearly, just type yes in the chat so that I know you are able to. Okay. Um, and yeah, I don't know how many of you are subscribers of MoneyWorks4Me already and live subscribers. So if you are, just type yes or type subscriber in the chat box. Of course, this is useful for both subscribers and uh, registered users who are not yet subscribed. But I just want to know if there are subscribers on the webinar. Okay, thanks, Sunil. Okay, now as you can see from the title, it's all about making informed decisions. Why is it important, and how do you take it? And Most of you would have access to the free features of MoneyWorks4Me, and therefore you are already equipped with the data, tools, analysis, insights. And the focus of today's webinar is really about how to use that in a skillful way to make better informed investing decisions. Yeah, so that's the objective. Okay, now just to give you a brief background about myself. Okay, I'm actually a Bombayite who, born and brought up there till 78. When I left Bombay to join IIT Kanpur, did my chemical engineering from there, and joined Hindustan Lever as a management trainee. And I was in Calcutta and Haldia for 3.5 years before moving back to Bombay with Castrol, and I worked there for 11 years. Spent time in Chennai, 3 years in Chennai, and 6, 7 months in Taiwan. The rest in Bombay. And in '97, I decided I wanted to move on and do my own stuff, and I started a business consulting training company. Um, that business is still alive, and I have a partner, Sriram, who is taking care of that. And in 2008, we diversified into e-learning and MoneyWorks4Me. So why MoneyWorks4Me? The reason why we started MoneyWorks4Me was because, while other areas of my life were working fine, the surplus money that I had, the savings that I had, were not working for me. They were not growing. And I tried everything. I tried investing in stocks directly. I tried investing in mutual funds, uh, and things didn't work out. Uh, and in 2007, I tried using a wealth manager. Said, okay, maybe I don't know how to do it, so let me use a professional service. And that didn't go too well because those were the days where people were really focused on selling ULIPs and high price stuff. I don't know how many of you ended up ever buying things like ULIP and all that and burning your fingers. That's when I decided that, okay, if you've got to make your money work, if you've got to grow your savings, then you got to do it more sincerely, more seriously. And therefore, I got into looking at, okay, how do you really invest in stocks? Because equity is the asset class that grows much faster than inflation. And that's the way to grow your money into wealth. But I didn't know how to do that. I didn't know how to do that well enough. And because I'm not serious about it. And many of us may be in the same situation right now. So the idea, the propelling force was, okay, learn how to do it. And that's when I got serious and started reading and looking at possibilities and trying to get data and stuff like that. In 2008, it was very difficult to get the kind of data that you require to make good stock investing decisions. And forget about just data. Looking at anybody trying to give you fiduciary advice, it was very difficult. So I said, okay, so if I'm facing this problem, I'm sure there are, many people, lakhs and millions of people in India who are facing this problem. And that's the starting point of MoneyWorks4Me. So MoneyWorks4Me was all about doing the right things in investing, doing fundamental long-term investing. And 12 years have passed, and we've gone a long way in our understanding and in our sight, and trying to create something that will work for retail investors. Um, in 2013, mutual fund direct plans were launched. And that was an opportunity to see whether actually you could also invest in mutual funds without having to suffer the sort of conflict of interest which is there with mutual fund distributors and stuff like that. And of course, the industry also has matured a lot thanks to competition and thanks to various other things. So we also got into mutual funds, and then we got into portfolio advisory. So we got deeper and deeper into this. At the same time, we had to reach a larger number of people, because people who are willing to pay are always a very small portion of the total number of people who need your services. And therefore, a few months ago, almost a year ago, we decided that we needed to upgrade what is available for free users, as in those who register on our site or download our app. And we wanted to give them a real good solution and a total solution on how to invest in stocks sensibly and successfully. And therefore, we launched a lot of new features. Work is still in progress. We are updating various pages and stuff like that with the new things that we have launched. And therefore, today I'm going to focus a lot, initially at least, on how to use the free features which are available to all registered users and to take informed investing decisions. So that's the objective, and I'm sure you're going to find this extremely useful. Okay. Now, before I do that, I thought I'll just ask a few questions so that I understand the audience which is there. And therefore, I'm going to ask you a few questions in the poll. And the first one is just coming up. And that is, what are you invested in currently? Is it direct stocks, uh, mutual funds, uh, debt funds, or gold, or are you a beginner? Sorry. Uh, Let me go back. Okay, now why is this not working? Choose an option before submitting. Okay, so most people, of course, are into direct stocks when they come to our site. Uh, okay, what's your age? It's a important thing to understand. Okay, some of you are answering this in the chat, so I'll just go there and check. Okay, direct stocks and debt funds, and read stocks and mutual funds, 55, 35. Okay, Vishal, you can't hear me? Is there the audio is pretty high. Okay, I'll increase it a bit. Okay. Is that better now, Vishal? Can you hear me? Okay. Now, tell me your biggest challenge in investing. What is it? Is it that you're not investing enough in equity? It's a multiple choice, multiple answers you can give. Is it that you're not investing enough in equity? Is it you're investing on and off? Is it that you're earning low returns, lack of knowledge, lack of reliable help, so fear of loss, or all of the above? What is it? Okay, right. Okay, let's start. Yeah, selecting the Vishal. Most people can hear. I'm sure something is wrong with why you're not able to hear me. Just check your settings. Maybe your uh, setting needs to be set right. Yeah, just have a look at it, because others, you can hear me. I'm sure you can, but just type yes if you can hear me, because there's a loud and clear. Okay, great. Okay, so let's start. Now, let's first understand why people don't succeed at investing, and then we'll figure out how we will succeed at it. Yeah. Now, the reason why most people don't succeed at investing is because they lack conviction. Okay. Uh, right. Conviction in what they invested. And why is that? uh, because of lack of knowledge, lack of experience, and lack of time. But why is conviction required? Because when you don't have conviction, you have what I call unproductive investor behaviors. And what is that? You get in and get out at the wrong time because you don't have conviction. You panic if the market is falling, and you get out, or you invest in a multi-bagger and you it doesn't work, and then you stop investing, and you don't stay invested long enough because the way to make money is allowing compounding to work its magic. But for that, you need to be invested. Today, for example, even in direct mutual funds, the duration of period for which people stay invested in a fund is very low, and obviously it won't work because if you're just going to be invested for 1 or 2 years, that's not how investing in equity delivers great returns. So that's a behavior that is there. It's unproductive. And why does that happen? Because you don't have conviction in what you invest in, right? So now, if building conviction is something you're not able to do or not willing to do, then your only option is to outsource your problem to somebody else, to an expert, for example, and say that, okay, let me go to an expert, to a PMS, or knowledgeable friend, or local neighborhood service provider, and hand over the kind of money to him and let him decide where to put the money. Or a PMS is a good example of what people do. And yeah, so are you comfortable handing over to an expert, and not getting into the hassles of what you decide, what you invest in, and not really understand, not really bothering about learning what investing is all about? Just give it to an expert and get on with life. Are you comfortable with that? Type yes if you are, and no if you're not. Yeah. Let me just wait for a couple of answers to see if people are comfortable in outsourcing their investing to another person. Yeah. And some of you may have already tried that. I'm not talking of using an investment advisor. Yeah. A fiduciary investment advisor is not, I'm talking of outsourcing it completely, where you are not in control. You don't bother about how to, right? Now, most people don't want to do that. Why? Because they don't want to lose control over where their money is invested. Yeah, it's very difficult because it's all hard earned money. Handing over control to somebody we don't know, and we have, we may not have enough data to sort of know whether to trust him or not. And this industry is funny. There are all kinds of people, uh, maybe like any other industry, but this has a challenge. How do you know that somebody is an expert? Yeah, how do you know he'll do what is right for you? Yeah, so there are trust issues which all of us have. I have, for example, and I want to be in control of where my money is invested. Okay. Now, even if you outsource it to an expert, you're not going to have conviction in the investment. You may trust the money, you may trust a person, but you won't have the conviction in what he's investing, right? And is it right for you? Certainly, the learning is limited to zero, in my opinion, and there is risk and there are costs. So many people are not happy with outsourcing their investment problem to other people, even experts. Okay. Now, till few years ago, this was it was very difficult to take charge of your own investments. Yeah, and there are some old veteran at stock investing who have burned their fingers and learned the hard way, and now they are managing their money well and their investment well. But today there are lots of things available, and technology has made many difficult things easy, or at least doable. For example, few years till maybe 10 years ago, you wouldn't have actually done your travel booking. Yeah, you would go to a travel agent and do your booking, right? Especially airlines and stuff like that. Today, whether it's international travel or any travel or air, people do it themselves. So the industry has simplified the process of doing it. Similarly, hotel booking, restaurant booking, the people have got around to making things easier for people to do it themselves. Of course, investing is a bit challenging, because it requires some knowledge, a higher level of knowledge than what I've already mentioned. Yeah, and you can't just take a poll of various people and go by, okay, so did you like the hotel and did you like the restaurant? You can't do that. Yeah, do you like the stock? Do you not like the stocks? Cannot be your basis for taking stock investing decisions. So it requires a little more knowledge. However, technology has made it possible, and today there are players trying to uh, sort of create solutions that will work for you and for retail investors. Of course, we started 12 years ago when there were very few such players, and we are still there. Okay, so solutions are available, but you need to know how to use them. Okay, now if you have to make informed decision, what does that mean? It means you should be able to answer these questions. What questions? How do you select the stocks to invest in? At what price? Yeah. When do you buy? Or when do you sell? Fully or partly? Do you act now or do you wait? And how do you build and manage your portfolio? These are the questions that need answering. And you're not going to rely on your intuition and your gut and your whim, or any news that you have heard or inside information. That is not the reliable and sustainable way of answering these questions. So what is? So the answer to this is that you need to have a process that you can follow, which will give you answers to this in a systematic manner. Does it mean that if you follow a process, you're going to be right 100% of the time? No, nobody is. No, not even all the gurus of investing are right 100% of the time. Yeah, they say that if you're right 70% of the time in stock investing, you're a genius and you will make seriously good money. Okay, so a process is a systematic way of taking decisions, and it also minimizes the role of emotions in your decision making. So process is what you need to follow to do this. Yeah. Okay. Now a process. When I talk about process to people, they all get a little worried because process seems to be something which is complicated. We'll have 20 steps, yeah, and stuff like that. Now, a really good process has to be straightforward. Yeah, so straightforward that even a 5-year-old will understand and be able to use it. That's number one. Secondly, it has to be so fundamentally right, that it keeps working through both market and economy ups and downs. Okay, so you can't have a process of investing that works only in a bull market, and so it's not going to work because the market goes through cycles. So there are limitations of processes which are sort of specific to how the market is moving. No, you can't have such a process because your money, you will want to, I'm sure, invest for the long term, which will be for your goals, which may be 10, 15, 20, 30 years away. For example, a retirement goal for somebody who was 35 years maybe quite is obviously a few decades away. So you're going to generate income for a fairly long period of time, and you need to invest that surplus for your future goals, which are all years and decades away. And in that period of time, the market and economy will go up and down. So you need to have a process which can handle all that. Do you agree with me? So till now, if you understand that process is what you need to focus on, type yes, because commitment to process is a very big step forward in investing successfully. Okay. uh, right? Not going to some other methods and funny things that we do. And I've made all the mistakes, and I'm sure some of you have also made many mistakes. The whole trick is now how do you avoid some of these mistakes and learn faster and succeed. Okay, so now we are going to really focus on a process, and that's what MoneyWorks4Me does. It is really about focusing on a process of investing, so that you can trust it, you can stay with it, and our subscribers who have completely sort of stayed with us for years have great conviction on the process, because they've seen it work. Yeah, and some of you who are new will go through the same learning curve. But what we have done is, for you to trust this process, we have built a site which gives you so many things transparently. So conviction and a process requires transparency. So when you take a decision on how do you select stocks, right? So you can have a process, but how do you implement the process? Okay. So that's why a site is available, and that's the right way to do it. A solution should have a platform, a site, an app which allows you to implement that process. And an important point of that is transparency, that you should be able to implement that. Okay, so how are we going to do this? Okay, now if any one of you has registered and not or not registered, please go ahead and register. Otherwise, you have all the tools which I'm going to show you. Right. So what are we going to do in the next 15 minutes? First, I'm going to explain to you a decision-making process that we call Decision, which is available to you as free users, registered users. And using that, I'll explain to you the process and the method and how to use the decision, the page to take decisions. Then I will look at any stocks that you want me to look at, and we will discuss that using the same process, using Decision. Okay, and then I'll explain to you more about how it works. Okay, so let's start with that. I'm going to take a stock so that it becomes easy to explain everything to you. And that stock is ITC. It was, or probably still is, in the minds of many investors. So all you need to do is type. So now you can see the screen. This is our site, and you just type ITC, and you get the access to the Decision, which is all about taking informed decisions. Now, what you see here is you see an overall rating, and it's 5 stars for ITC. And where does this rating come from? It comes from looking at 3 things: quality, valuation, and price trend. Okay. Uh, Quality is the answer to the question, should you even consider investing in this stock? Okay. The second question is this price attractive for success or getting good returns as a long-term investor? Okay. That's where you get the answer under valuation. The third is, should you act on it now or should you wait? And that answer you get from price trend. Okay. Now, ITC on quality is very good. Okay. And I think that's many of you who are into stock investing will understand. So quality is not an issue with ITC. Okay. So it's very good. And there is a basis for that. I will explain to you how this rating or green or 2 stars has come about. Right now, just understand that there is a rating on this. Right now, at this price of 222, it is somewhat undervalued. Okay, and this is compared to the past. Today's price, based on certain key ratios, it is really somewhat undervalued. So obviously, it makes it attractive to even buy it. The third is showing a price trend. Price trend actually is about momentum, is about will the price go up in the short term. If it is strong or if it is strong, then the indicators are, as an investor, I'm saying, not as a trader, as an investor, in the short term, few months, the price will continue to rise. So if it is strong, it is likely to rise. There is momentum, and therefore you are better off, because right now it is undervalued, and the market may just about wake up and price is going to rise fast. You may lose the opportunity. If it is semi-strong, you can buy a little bit and wait for some more time to check which way it is going. And I'll show you how to check that also. But right now it is showing semi-strong. If it was weak, okay, then you are better off waiting. Okay. Now, if you see 5 stars and all this rating, then is there? So it's a good stock to invest in if you're a long-term investor. Okay, that's a conclusion. Okay, so some of you may still ask, so why is it that the performance of ITC is lackluster? I'm going to give you the answer right away, but of course it requires you to see something below. Now, this is the 10-year X-ray, and you can see it right below on the same page. Scroll down, and you will see things, key ratios here. Okay, you'll see return on capital employed, which is about how efficient. I'll talk more about that, but you'll see it's green. Now, the problem with ITC, you can see, is in the sales, right? It's not growing well enough, okay, or fast enough. Though this year TTM shows jump, that's the problem with ITC. Okay, so it's a high quality stock. Valuation is somewhat undervalued. Price trend is semi strong. Uh, yeah, long term it is good for investing, right? And you can take a decision based on that. Okay, now having said that, let me stop here for a minute and go to see if you have some question. I can see one question is there. Okay. Yeah, I have ITC in my portfolio, Vivek. There's a question Vivek Yadav has asked. Um, and you can assume that any, okay, this is part of our coverage. So we give calls and stuff like that where we make the disclosures about it. So I personally bought ITC after waiting for many years and not investing in it. Uh, right? Performance has been okay, okay, nothing great. But yes, I have invested uh, and I think it's a good decision. I still continue to hold it. Okay. Now, in terms of understanding decision and how you use this, any questions you have? No, no questions. You have understood this? Okay, I can see somebody's typing something. And some of you have understood this. You can suggest some stocks which you are interested in, and let's see and understand better how to use decision and use MoneyWorks4Me company page to take better decisions. Okay, Allied Digital. Okay, anything else you would want to discuss? Vivek? No, we don't have data on debt funds. Yeah, tin plate and Allied. Only Afraz is giving suggestions. Is the Wipro okay? Wipro, Tinplate, Allied Digital, Tata Steel. Okay. Okay. Let's start with Tata Steel and yeah, TCS, Wipro. Okay. Let's start with. We'll cover all of this. Okay. So let's start with TCS. It's a simpler one to look at. By the way, I also have Tata Consultancy in my portfolio. So let me uh, however, this decision is totally based on data. It is not something that any one of us, including myself, um, uh, change. It is all data based, all algorithm based. So you can rely on this because this is all about data analysis, and you get answers based on certain parameters. And I'll tell you the parameters what they are. That also I can tell you very transparently. Okay, so we don't give, and these are all. This is a free product right now. It's all database, all algorithm driven. Of course, using our wisdom of the past 12 years, but they are not something that we are personally changing or manually changing. So you can rest assured this is all generated by the system. Now, TCS is obviously a high quality company. Valuation is overvalued and the price trend is strong. Yeah. So prices are going up, and you saw the results. It is overvalued. Okay. Now, um, why is it overvalued? Essentially because let's see some charts over here. Now, how do we look at valuation and tell you it is overvalued? Okay, we do this by looking at key ratios, data over 10 years, and then we look at what's the price that people have paid in the past, and what was the ratio at that level, say the median. Okay, and today, is the price somewhere close to the median? Is it somewhat higher than the median, or is it substantially higher than the median? So what we have done is, for every industry, we have some key ratios that we look at, and we give some weightage to those ratios. And based on that, we are able to say that this looks overvalued. Now you can see, for example, price to earning. Currently, the thing is substantially higher than the past. Okay, you look at enterprise value to EBIT. This is again slightly uh, tweaked by us, but this chart is the standard enterprise value to EBITDA, and you can see that today it is higher. Okay, price to sales, again, all of these are high for TCS, and therefore you can say that today's price is high. Okay, now if you see the trend, price trend, it is showing strong. What it means is there is momentum. Okay, and how do you see this? You see that, okay, so there is a 50-day moving average line, the black one, and there is a 200-day moving line, which is a slower moving line, which is the brown one, okay, or the orange one. And you can see that last 1.5 years, the 50-day moving average has been consistently on higher than the 200-day moving average, which means there is momentum in this, and it continues to be there. Obviously, stock has grown substantially, so it is overvalued. Now, there might be people who believe in momentum investing, or you might be a long-term investor and say that, okay, if I continue to hold this for the next 10 years, is this price going to be, really very high? Will it matter? It may or may not. Uh, but I think few months ago there was an opportunity to look at buying this at a lower price. Okay, right. So now you have understood on TCS. Let's go to another Tata company, Tata Steel. I don't have this stock. Okay, so what does this say? This says that the quality is somewhat good, and that's understandable because steel is a cyclical and a deep cyclical industry, and therefore it goes up and down. You'll see ROS is, it's improved now, it's 11.6, but it has not been very good in the last 10 years. Uh, Sales also has been cyclical, and so has the earnings per share, which is the next line, earnings per share. Again, it's a cyclical industry, so quality is uh, somewhat good. Yeah. Okay. Now, there is, apart from ROS, and I'll tell you why this is important. ROS is all about how efficiently the company uses capital, right? And for large cap companies, you would expect a certain minimum threshold rate of efficiency in generating returns, which is obviously not there in some of these. It is 9, 7, 3. This is below the hurdle rate by far. So this company has not been generating consistently return on capital employed, uh, right? But March 19 was good, March 21 was good, but not all the time. And the second is free cash flow from operations minus investments. So this is cash flow from operations. We remove the capital investment that businesses do, and then figure out if there any free cash flow left after these investments. And if that is consistently positive, then we say, okay, that's a good, strong company for us. Okay, so I've revealed to you the two parameters for quality, which is ROS and free cash flow. Okay, ROS you can see straight away over here, it is low. Okay, right now it is somewhat overvalued. Again, you can understand that from the valuation charts, and the trend has become weak. Okay, okay. Uh, if there are any questions on this, I'll take it later. Now let's go to the next one. Was Wipro. Okay, Wipro quality is very good, overvalued. Yeah, not just somewhat overvalued, overvalued it is saying, and price trend is semi-strong. Okay. Now, you may say that, okay, this is based on the past it is overvalued, but maybe today the performance is better. Okay, so how do you check that? One, you check the 10-year X-ray. Okay, you can see the growth is good. Sales, orange many years, couple of reds, no, more than a couple of reds. Wipro did have some problems in the past about leadership. But right now, it is obviously all IT companies are improving, and so is Wipro. So the way you would look at it is okay, compared to other companies, yeah, Wipro has had trouble. So did Infosys for that matter. Okay, so a little bit not very good, good performance, but not great performance for some years. Um, EPS is growing last 3 years quite robustly. Yeah, cash flow from operations are good. Yeah, everything is fine. But what you can see, and what I wanted to show you was, you can see sometimes recent performance. Okay, we have made a special new thing created called recent performance summary, and there you can see what's happening and what's not happening. Okay, and that will help you take a better decision. So Wipro is, yeah, again, it's a problem of valuation. It's expensive. Okay, and you can see that from the charts. And this is going to be, you can see it's high. Yeah. Okay, let's see something else. Somebody said tin plate. Let me see tin plate. Okay, so this is again quality is somewhat good, valuation is somewhat overvalued, and price trend is strong. So looks like momentum is there in this stock. Quality is somewhat good, so you can invest in this. However, it is somewhat overvalued right now. You can check something on the let's see quarterly results. We'll see what is the current P. Current P is 14. Okay. Uh, Performance is sales growth is subdued in the last 3 years. Net profit is good. Return on equity is good. Yeah. Recent sales in last 4 quarters is obviously very good. It's 90%. So you can see that why the momentum is there. Okay. So barring a peak over here and somewhere here, many times the price has remained subdued. So this may not be, it's somewhat overvalued. Can't say exactly how much it is overvalued. Uh, right? So if you have a better understanding of this company, this could be a threshold thing. You could wait for a better price, but that's not going to happen in a hurry because the price trend is strong. Yeah, if you have conviction in this, you can look at, yeah, you can say, okay, somewhat overvalued. You may still want to invest in it. Okay. By the way, this is a small cap company, so this might rise very fast, and things change more rapidly in a small cap company. Or you would, if you're conservative, you would wait for a better valuation. Okay, there was one more company which I forgotten the name. Tin plate and okay, let me see. Okay, there's a DMart sequence. Okay, we'll see some more. Uh, Allied Digital. Okay. Okay, any question? There are two questions here. Let me check that. How to recognize if a company balance sheet is adjusted? What do you mean by adjusted? I mean, is it adjusted for extraordinary items? Could you explain a little bit more? What is your question? What to do if share is having a strong fundamental but overvalued like Mindtree? Well, you just wait and look for other investment opportunities. Yeah. The problem with cooked. Okay, so I will answer your question on this. Okay. Now, there will be, see, today you are in a bull run, and therefore many prices are up and overvalued or somewhat overvalued. Now, don't be impatient. Yeah. Uh, because it goes through cycles, and don't get stuck on a stock, don't get stuck on Mindtree. You need to see, okay, it's a good quality company, put it in the watch list and wait. Okay. um, right, and wait for opportunities, but look at opportunities today which are at fair value, because then quality and fair value together will assure you of good returns, healthy returns. When you buy an extremely overvalued company, the chances of mediocre returns is high. Yeah, because prices, when they go well ahead of the growth of the company, growth in profits of the company, then obviously at some point of time it has to revert to the mean. Okay, so that's what happens. Prices go very high, well ahead of earnings. Then at some point of time, and this could go on for a couple of years, where the prices remain somewhat stagnant, and then your returns are not going to be great, right? So you need to invest in good quality companies at a fair price, a reasonable price, and avoid the extremely high priced high priced stocks. Yeah. Okay. Now the question was, there's a question here: difference between trailing PE and forward PE. Trailing PE is when you're giving it, you're dividing the price by the trailing EPS, which means maybe trailing 12-month EPS. Okay. So last 12 months EPS is the denominator, you get the trailing PE. If you have an estimate of the forward earnings, yeah, then the today's price is divided by the forward earnings, and then you get an estimate that, okay, if this company delivers so much EPS, what is the price you're paying today, what's the PE that you're paying today. Okay, so that's the answer to trailing versus forward PE. Can we see macroeconomic data on the site? No. Macroeconomic data to be is not available on our site, but it's available in various places. Uh, right? We do use it in our analyst notes as to how the macroeconomic data is affecting certain industries. Yeah, but we don't have a general macroeconomic thing, which a lot of sites, newspapers all carry it. Now, if numbers are cooked, okay, you will see a aberration. You will see a contradiction. Okay, so let's go back to the site. So you will see some aberrations in the, or some contradictions. Okay. Let's go to any company. Let's go to Mindtree. Of course, that's not going to have any uh, problem there, but okay, so Mindtree has got strong momentum, strong quality, is overvalued. So unless you're willing to wait for a long time and be happy with mediocre returns for a few years, it may still, momentum is high. So short term you'll see it prices going up, but medium term maybe it will revert to the mean, and therefore the model says that it's overvalued and you're better off waiting. As a value investor, as a person who wants a reasonable price, this you need to wait. If you're a momentum investor, you might invest in it, but momentum means you got to get in and get out much faster than what retail investors are comfortable to do. Okay. Now, if you will see, what we have done is that we have given a set of ratios. This is to answer the question: how do you find out something very quickly, whether something is amiss? Okay, and you'll see that you'll get some indication from the from this X-ray. Okay, so what we have done is, okay, we got to first see ROS. If the ROS is good, then we look at sales. Is the sales growing? Okay, and if the sales are growing, is the earnings per share growing? If both are growing, it means there's a likelihood that market is, I mean, it is doing well and everything is, as you would expect. What you need to see is cash flow from operations. Now, when you generate profits, Okay. So adjusted net profits you can see, and you can see the cash flow from operations is generally higher than the adjusted net profit. So this is unlikely to have any hanky panky happening over here. But when you see that cash flow from operations is consistently lower than adjusted net profit, then something may be going wrong. Because why is the cash flow from operations always lower? It should raise some alarm. Okay, so that's one indication. Okay, there are a few others. Yeah, and you must, of course, there is what is called forensic accounting practices. So you can, check whether check and look for contradictions. Okay, and there is a whole thing on that. There are books on that as to how do you pick out, uh, people who are scamming the balance sheet and P&L accounts. But here, if you see, consistently across these parameters, if the numbers look consistent, right, then it's fine. For example, the sales are going up, but profits are not going up. Yeah. So what's happening? Are they losing margins? Okay. If they're losing margins, then obviously the PAT will be down. Then what's happening to the cash flow? Is it consistent or not? Okay. So if you see numbers across this, you can see margins. Are they improving or going down? Okay, so somewhere people will make a mistake. But of course, there are scams like Satyam and all which happen, which are very difficult to catch, even for the best people. So what we do is we look at management quality. Okay, and by looking at management quality, we this is not available in free, but we generally look at management quality and then make a suggestion or a recommendation. So these two ways. So anybody who's got a track record of not being fair to minority shareholders or doing something which is wrong, then that has some track record. There is some history to it, and you want to avoid that company. Okay, let me quickly check Allied Digital. At one time, it was quite a. Okay, so this is really only 1 star, and you can see Rose is absent, right? So this is okay, completely avoidable company if you ask me. Okay, what else was there? One last company we'll take and then move on. Sorry, this is. Oh. Sorry. I'll go back to. I don't know. I'm sorry, you do. I did not share the screen while explaining the problem of accounting. But basically, look at the 10-year X-ray and do that. Yeah. Okay. Which company can I show you? Let's see, Reliance. Okay, now Reliance is coming as somewhat good, even though the market and many people in the market love it. Why is it coming somewhat good? Yeah, so you'll see Rose. How is the Rose? Rose is not good. Yeah, see, it's making returns less than what you would want a large cap company to do. 8.4 and all this are not. It's not very good number. So this is a worry. Why is the Rose low? It's not because it's not profitable, but because capital employed is large. Okay, so right. So we look at these, and also we look at cash flow from operation minus investments. That some companies are investing a lot in their business, more than the cash flow generated by the operations, which means they're consistently putting money back into the business. Okay, now that for some years is fine. So when you put money back into the business and not generate ROS, then the future is not very good for you as a shareholder. Yeah. Okay. So that's why you'll see that this is right. Now you will see again, cash flow from operations is lower than adjusted net profit. Okay, some years, not all the time, some years. Let's see Adani. Maybe we'll get an answer there. I'm going to stop with this Adani Enterprises. Let's see. Okay, so again, somewhat good. You'll see Rose was not good, but it has improved in the last 3 years. Okay, sales also is somewhat stagnant to growing. Okay, so that's how you will get the answers. Lots of it is there. I can't cover everything. Uh, So, if you want to find good stocks for common investors, right, all you need to do is go and look for good quality companies which are available at a fair price. I will show you how to do it. There is some work going on to give you a better screener. I will show you that also. Uh, okay. DMart again, good quality company, but momentum overvalued. It's quite obvious, uh, right? Okay, let's stop with companies now. Let us look at another important thing, which is the screener, which will allow you to now, this is still work under work in progress, but I want to show you what will be available in a few more days. Okay, so now I've come to a Nifty 50 company, and here you will see that we have given the decision ratings on the list. Yeah, isn't that fantastic? So you can see the five rating on 5 star. You can see the rating on quality, valuation, and price trend in this list. Okay. Now we are going to put the filters so that you can actually filter on any one of this. Maybe next week that will be available to you. So you can filter on star, or you can filter on quality. You can filter on valuation and things like that. Okay. So using this, you'll be able to find as a free user some good companies. Yeah. Now you can see in Nifty 50 companies, many companies you'll find quality is good, valuation is high, price trend is strong. Of course, PSU like Indian Oil Corporation, it may not be, it might be reverse. Valuation may be, in fact, attractive, but price trend is somewhat strong, semi-strong. Quality is again somewhat good. Okay. Now HDFC Bank, right? Quality is good, valuation is fair, and price trend is strong. So this makes it a good stock to invest in today because its price is not is fair value. Okay. So you can look at this list and see. Of course, Coal India, again, you say PSU, so you may not like it, but yes, it is interesting. Now, when you get this screener, you will see that okay, IndusInd Bank, it went through some trouble, but as a bank, past data shows it is good quality, valuation is undervalued, but price trend is weak, not yet. So using this, you will find uh, some. Of course, once you get the new features for filtering out, you can even do it straight on that. And the good thing is you can add a few more screeners here. For example, you can add, 5-year sales greater than say 15%. Okay, and you update the list, right? So you'll get, for example, 15% 5 years growth rate. Only two companies are shown that. Okay, in this. So you can maybe reduce it to 5 years sales growth more than 10%. Okay. No, there has to be more than that. Something has gone wrong. Let me. No, this is become. Sorry, this is. Let me refresh this. Okay, there's a bug today. I can't see why this is not going off. So you can use more filters to select within that range, but really the star rating and the rating on quality valuation price trend is really interesting. Okay, let me see if there are any more questions and then move on. Okay, good. So we have covered a few stocks and we have understood. Okay, most of the shares are trading 200 days to 200 to 300% price more than what they were 2 years ago. Also, the balance sheet shows sudden rise in sales, difficult to digest. Uh, there is no sudden rise in sales. What happened was last year some sales have gone down, and then obviously with a lower base you'll see a jump in the sales, right? So I don't think too much has happened on sales and profit growth. Um yeah, but yes, some companies have done well. Um, but in a bull run, no, this is what happens. Uh, Even somewhat good performance gets fantastic prices. That's why it's a bull run, right? So you have to be careful. You have to wait it out, and you have to go only after good quality companies. Yeah, there are, and please be very careful when you go to small cap, mid cap companies. Yeah, don't just jump into them. You need to look at the balance sheet. You need to look at the X-ray on MoneyWorks for me and see whether it's really consistently performing. The trick is when you look at it over 10 years, you will know is this a consistent performer or just a flash in the pan. And a flash in the pan is not something that you're going to be very excited about. What's your favorite tool filter to check the company? Are they fundamentally sound or not? Yeah, I will now use only the quality rating on decision, and after that I will check sales growth. So Vivek, my answer to your question is look at quality green and then look at sales growth if it's happening or not. So it may be fundamentally sound, but also sales growth has to happen. If that is there, I will be happy. Okay. What are your views on Nifty today? Is it fairly valued? No, Nifty is overvalued, right? Okay. So, but you need to go deeper and see which companies are overvalued, which are not. Okay. So it's not just about, yeah, it is overvalued. Certainly, it's overvalued. But you need to look at stocks, and there might be there are opportunities today also. Yeah, and not all the opportunities are neat and clean. Some of them will have some question marks, like ITC growth will be a question mark. HDFC Bank, it's again good quality company. Prices are not rising as fast as it should. People, I don't know. The market seems to be a little lukewarm about it. So yes, it's an opportunity. HDFC Limited, again, there's an opportunity. So these are there. Okay, I've already told you some of the best stocks today, right? So the idea is not that. The idea, see, Afraz, the idea is to learn the tool so that you don't have to keep asking us the question. Okay, if you look at the ratings today, right, and you will see good quality, fair or somewhat undervalued. You found a good company to invest in. Okay, do you do it now or not? You wait on the price trend. The idea is like use a tool to or a process to take decision. Don't rely on an expert or some market data or market tips or recommendation or broker recommendation. The idea is to tell you a tool is available with you right now which you can use very effectively to come to your own decision. So Afrad, all you need to do is maybe next week you will get the filters on the quality valuation separately, so very easily you will find the companies that you need to track. Okay, so you don't have to ask other people. So the purpose is very clear. You become a little more self-sufficient, not fully self-sufficient, but a little more savvy because of the tool that and data and analysis that you now have. Okay, now let me go and give you some quick I've already told you about this. Quality is based on ROAS being higher than a hurdle rate and generating free cash flows, which is cash flow from operation minus investments that they do. And when it is consistent, highly consistent, high consistency is green, somewhat consistent is orange, and not consistent or poor numbers is red. Okay. Uh, on valuation, we check what people have paid in the past. I'm just summarizing it, and then you look at relevant ratios over 10 years. And when it is around the median, it is fair valued, orange. If it is below that, it is green, 2 stars. And if it is higher than that, then it is either somewhat overvalued or overvalued, and it is red and no stars. And price trend I've showed you, it's all about momentum. If it is strong, then it is likely to go up in the short term. If it is semi-strong, it will go up, but you can buy slowly and watch. And if it is weak, you could wait if you want to for a better price. But always remember, market is quite dynamic. Prices go up by 5%, 10% sometimes in a day, and something which is undervalued can become fairly valued in a day or two. So you have to take your call, but you have the tools to take good decisions. Okay, now we have done this. I've shown you the screener, and a better one is coming your way. Now, some qualifiers, because is something which is important for you to understand. What are the limits on this tool and what you're getting as a free version? First of all the ratings are based on data. So it's all on past data and analysis of past data. So what is missing? For example, in quality, past may show good quality, but how is the future is not visible on the decision free tool. Is there a turnaround? Again, you can see the recent performance and come to your own conclusion, but there's no, I mean, there is an indication by looking at this recent performance, you can get some idea whether there's a turnaround happening. 3 years, if you see something is happening good, then it seems to be going in the right direction. But is it a real turnaround? The answer is not there. And valuation is not based on intrinsic valuation. It is not based on some equity analyst looking at the free cash flows in the future and coming to an answer. It is based on historical ratios. Of course, we have done some interesting tweaks on those ratios to find out based on what people have paid and the key valuation ratios, is it fair or not fair valued or overvalued, undervalued. However, if you look at it at a portfolio level, right, you look at a set of stocks to invest using this process, right, green, mostly green companies, and undervalued to fair valued, and use price trend for entry. As a portfolio level, you'll do fine and you will succeed. Yeah, but at a stock level, even as a, I mean, even if you use expert advice, you're not going to be right about every stock in your portfolio, right? So if you have 20 stocks in your portfolio, certainly one or two will not be right, and two to four may be somewhat okay, right? But you need to move out of that, and at a portfolio level, you'll still be fine. This is the thing. So I just want to tell you that obviously, yeah, the thing works, and you know how to use it at a portfolio level. That's the now, yeah. Before I come to this answer on IPOs, which I'm not a great fan of, right? I just want to quickly conduct a poll on what you saw on the tool and the X-ray. Yeah, how did you find it? Yeah, so if you can uh, give me your. So if you liked it a lot, it's a aha. It's fantastic as a free tool to use and take decisions. It's 5 stars. Uh, yeah, or 4 stars, 3 stars, whatever you feel after looking at the. Uh, okay, I think some people are okay. Now, the other question on IPOs, we send out reports on IPOs and whether you should invest in them or not, and you can refer to them. Yeah. So when you look at an IPO, So we have reports on the big IPOs which have come out. So best to look at them. I do not want to make a loose statement around it. But in general, IPOs always come during bull markets. They are always fantastically priced. Uh, and if the bull market were to be over in a month or two, these would correct substantially, is what I would feel. So there, we are betting a lot on the future. You got to be very patient, even with the best IPOs. Uh, and yeah, I mean, we are not venture capitalists trying to pick some future winners, right? So my suggestion is be very cautious. Put some small amount if you can't resist it. Yeah, but IPOs is not where you will put your retirement fund and your future goal funds is not something I would put in an IPO, right? Uh, right. Okay. Is there any question? So you have understood the free part. Is there anything else? Okay. What are the features available for paid subscribers? Okay, good question. So if everything I've shown you is available uh, to you as a free, then what's the difference? Why the paid? Okay, good question. I'm going to answer that. I've given you some indication as to why. So I'm going to now log out of this free and log into the paid thing and show you. Now, let's look at a stock. Let's say Bharti Airtel. Okay, let's see how the paid version looks a little different than the. Okay, let's see the. Now, if you see the free part on decision, the free decision you'll see quality is somewhat good, overvalued, price trend is strong. But if you see the paid one, yes, you'll see the quality based on 10-year X-ray is somewhat good, right? Long-term prospects is very good, and you will see something called MRP, which our paid subscribers get. So MRP we have equity analysts have given is around 700 rupees. Okay, and today is 721. A few days ago it was. So when we gave a call on Bharti Airtel, I think we started giving a call at 370. Okay, so that's the benefit you get as a paid subscriber. There are things which are happening which past data cannot capture. Yeah, sometimes consistently performing companies, past data and equity analysts thing will be close. Okay, and we have seen this when we have tested the free product also. We have seen this. So many times it will match. Why? Because they are consistent performance. There is no sudden change or there is no substantial change in the situation. But in Bharti, in the telecom, there has been a change, right? We all know about it. So that's why you'll see that there is a need to look at intrinsic value, look at future prospects, look at future cash flows, and then come to a conclusion, right? Again, there is a valuation upgrade. Likely is the message that the equity analyst is giving our subscribers. Okay, so this is what happens uh, for a paid subscriber. And when you look at the price chart now, let me show you the price chart which a paid subscriber looks at. It's quite different. What you're seeing over here is there is something called a MRP, yeah, and a DP line, or discounted price. This is a margin of safety, and you will see the what's happening over here, right? So when you see the MRP is actually fair value, intrinsic value as computed by the equity analyst. Okay, say in this period, right? What was the fair value? Fair value was 612, right? What was the price? Price during pandemic, of course, went down substantially. I think it was how much? $400. Okay, and before that, again, there were opportunities here, right? It And there were opportunities in 2019, right? When the MRP was 450 and the price was 337. Now, this is what happens. This is what paid subscribers look at. Now, I also must tell you that I'm also invested in Airtel. So you know that this is not just advice we are giving people, but we are invested. It's a substantial. I think it's the third or fourth highest in my portfolio. It has become that. It was not that to begin with. So this is the beauty of. I don't know if you were able to see this. Sorry, again, let me just go back to this. Sorry, you may not have been able to see it. Yeah, Sunil, just go ahead and leave. We are mostly done. I was showing you the price chart with the MRP DP line. So MRP is a fair value, intrinsic value computed by equity analyst, and you can see that there were ample opportunities to buy Airtel, and I don't think people were doing that. So many subscribers of ours would have had Airtel in their portfolio. I certainly have it. Many people have it. Okay. So all the way till today, when the price is 700, MRP is 700. Yeah. So this is the benefit. There are many such options. So this is the beauty of the paid product. Okay. So my recommendation to people is you use the free portion, get comfortable with it. And if you have a substantial portion, 5 lakhs, 10 lakhs, 20 lakhs, you need to invest. It is better to invest in fees for an investment advisor. We are fiduciary. We don't earn any commissions on your or brokerage or anything like that. It's completely, we work for you and we rely on your fees for our revenues. Yeah. So it is a good investment to pay the fees for an investment advisor and buy a product, which is obviously a couple of notches more useful than a free portion, right? You will get either it will be kind of endorsing each other, the free part and the equity analyst views, or there might be differences which you will understand why the difference. Like Bharti Airtel explained to you, there's a difference compared to the past and today, and you will be able to therefore invest with confidence, right? So Bharti Airtel, knowing the past and knowing the future analysis changes that are happening, you could have made a substantial investment in that. Similarly, there are many companies like this. Pharma was like this years ago. Many opportunities were there, but it was out of favor, and there were opportunities to invest in that. Similarly, so many opportunities come, which the second thing is when you have a large amount of money, you don't want to make mistakes, right? So look at the paid product, either Superstars or Omega if you have more than 25 lakhs, and talk to our investment counselor. I'll give you her number. This is MoneyWorks4Me's performance. Yeah, 20% CAGR over 7-8 years as compared to 13% on Nifty. This is for the paid product, right? So it works, and it has worked, and it is, in fact, doing even better now. So, if you are comfortable, I hope you are downloading the app also. This is the number of Ruchira. You can speak to her, 98603 59463. Okay. Now, I would strongly suggest I see some names people have come, sometime before also. Talk to our investment counselor, and you can move on. If you're fairly comfortable with MoneyWorks4Me, you have used the site for some time. It might be time to move on and take some dedicated, serious action on your investments, and talk to them. If you are considering a paid product, tell Ruchira that you attended this webinar,
and she'll be able to then, if there's a discount for webinar customers, she'll be able to pass it on to you. It may not be substantially more or big, very big, but I'm sure you'll get something on some products, not on all products. But I just thought I'll tell you that. Okay, if there are no more questions, then I will end it. Is that fine? Did you see value in the webinar? Type yes if you got great value, say lots, or give me a thumbs up. And yeah, so I really would like you to help us by, uh, of course, downloading the app, giving us reviews, yeah, and of course referrals. So some reviews, good reviews, if you can give us, and tell your friends to use the free product, download the app, use Decision, which is a fantastic product. Currently, all of it is free. So tell your friends, and soon we'll be launching a referral program where we would like really people who are advocating our site and our way of investing. Uh, we are really going to have a very attractive referral programs where uh, uh, you will also get rewards for recommending, and which means if people whom you recommend download the app, you will get some cash back, so you can buy our paid products at a lower price. And should any one of your referred customers buy the product, then we will share some 20% of the revenues with you. In addition, we will be giving 10% 10% extra discount to the person who's buying, who's been referred by you, and 20% will be given to people who are referring. So we are really looking at uh, people who are happy with us to help us grow. Yeah, so that's the request to you. Download the app, and when the referral program is launched, yeah, please spread the word as much as you can. Yeah, thanks a lot. Thanks, Deepak. Oh, Mr. Sadashiv Kamath is back on the webinar. I don't know if he's still there. Okay, how much money to be kept for liquid fund to put during market correction? So, Sadashiv, your investment advisor, somebody would have told you that, but what I see for Omega customers, a lot of the money has got deployed. So I would say around 20% if you have for market correction. So if you're already invested a lot and fully invested, nothing wrong with it. Uh, but that always doesn't happen, especially, yeah. Now, Mr. Sadashiv Kamath has asked a very fundamental question. You should attend the webinar of our equity analyst, Sadashiv. Yeah. I'll tell you my take on this just to end the webinar. My take on this is very clear. We are in for this is a time, India's time. I've been here for what, 30, 40 years now almost, right? And we have always waited. I'm sure, Mr. Kamath, you would have also waited for India to take off, and many decades have gone by without that happening. And it's the people who are older amongst us would have reasons to be skeptical about India's future. Yeah. But trust me, most countries which have done extremely well, um, there was a point of inflection where things changed, and after that, for a decade or two, the growth was fantastic, and everything changed dramatically in the country, in those countries. That's how these countries, Southeast Asian countries, for example, happened. Okay. My take on this is India's time has come. Structural changes have happened. Yeah, things which we had never imagined have happened and are installed. GST, yeah, digital, things. Mobile is everywhere. Yeah, people accept digital as if we were born with it. Infrastructure, improving at a rapid pace. Yeah, and the commitment of the government to make all this happen is very strong, and they are good implementers. Okay, so my understanding of this is that long term, India, 10 to 12 years, India will become a $10 trillion economy. Okay, so it's a long term bull market. Now, sometimes the market will go ahead of itself and therefore it will correct, right? So don't try to time the market. Stay invested. Uh, I think we are in the best times of our life as far as country is concerned. So stay invested in equity, liquid money if you have got. Look for opportunities and invest in them. Of course, book your profits from time to time. It's not that you don't have to book your profits. So some stocks which have run up a lot, maybe those are the ones that you need to sell and create the liquid money to buy new opportunities. Yeah. So that's the way to do it. Okay. Okay, thanks, Mr. Kamak. But I would say stay invested. The real thing is about belief in the country's economy and that the market is going to be a strongly growing market for the next decade. Okay, your job as an investor is to a stay invested, b stay invested in as good an opportunity as you can find with good advice, because it's obvious if your portfolio is going to grow, the fees that you pay to an investment advisor is going to be very small, right? If the portfolio was going to be stagnant, then you need to worry about fees. Yeah, right. So find a good advisor. Those who don't have it, strongly consider Money Works for Me. We are fiduciary, we are transparent, and find a good advisor, because the best of times is ahead of us, and you must be fully equipped to invest in equity confidently. Yeah, yeah. So market will correct from time to time. Yeah, but it's all corrections in a bull run, in my opinion. Yeah, until something very untoward happens, which no one can predict. Like pandemic also happened, but it was a good solid recovery after that. So wouldn't worry too much. How do you deal with big losses? Any precaution? So stay with quality companies, even when you have losses. Uh, so let me give you a thumb rule, which will help you. Yeah, Vivek. The thumb rule is that 65%, two-thirds of your portfolio, equity portfolio, you invest in core companies, what we call core companies, resilient companies, strong companies, large cap companies, quality large cap companies. Okay, so two-thirds you invest in that, uh, right? If you are into stock investing, that's the way to do it, and let that grow and follow a buy and hold strategy. There will be okay. So in the next one third, the remaining one third, you can put in mid and small cap, good quality companies. Now, good quality, but they are small cap. Volatility is going to be high. You are going to see some losses. But this, if it is good quality and you follow the advice, yeah, then for example, Sequent, Sequent, we started buying at 130 rupees. At 280 rupees, the equity analyst gave a sell call. Now, not all of us, I'm sure, believed in it and sold our holding. Okay, some of us did not. And then the price corrected, it's come down to, I think, 180, 190. So from the peak, you will see a loss. But if you had started investing in this at 240 and those kind of things, you will see a loss. Now, if you follow a process of quality companies, right, even a big loss which happened, for example, during pandemic times, okay, all our subscribers were confident because they were sitting on solid companies, and they were confident to buy more when the prices corrected during the pandemic, because even very good quality companies were available at fantastic discounts, right? Now the way to deal with losses is, if you've got a bad process, yeah, book your losses and move on. right? But commit yourself to a good process. Yeah, that's the learning from things. Yeah, a lot of momentum investors, I don't know the reasons for your losses, but you need to take the punch on your chin and move on. And let it not completely affect your confidence of investing. Though, if you are overconfident, a little bit of correction is important. Yeah. Uh, Now, short-term losses is a pain you need to just grin and bear it and tell yourself this will go away. Yeah, that's what I do. That's what most investors in quality companies learn to do. Yeah, because of course, yeah, quality companies don't come at I mean, they don't come cheap, and sometimes you are paid a fair price, and it may go below fair price. Okay. Yep. Thanks, Mr. Sadashiv Kamath. Okay. So great. Thanks a lot for being on this webinar, and best of luck in this year, 2022. Okay, so I'm ending the event. Thanks once again.